in the back half of 2025, we saw an acknowledgement, a real inflection point from customers that said, certainly for a while, we're not going to have perfect information about trade policy, about economic clarity. However, they've moved off the sidelines. I think there's an acknowledgement that supply chains need to be adaptable rather than continue to wait for perfect information. And I think that's really going to shape a return to normal in a lot of different spheres of the logistics real estate market.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. As we welcome the new year, it's a great time to check in with my guest, Melinda McLaughlin, Global Head of Research at Prologis, on some of the major supply chain trends and themes expected for 2026. Melinda, thanks for joining the podcast again.
Thanks for having me, Sarah.
So first off, Prologis is expecting international logistics markets to outperform in 2026. Can you expand on that and put it into context with what you've seen in recent years?
Absolutely. This is actually a continuation of what we saw in 2025. And it's a combination of the evolution of the cycle and unique structural factors affecting different international regions. A lot of times we compare and contrast first the US, and the US definitely led growth during those pandemic boom years. And it's been leading the correction over the past few years in response, as you might expect. Outside the US, in Europe, we see continued tightness. And this is a lot to do with both demand, which leans a bit more structural. So supply chains still modernizing over there, and outsized e-commerce growth are really driving expansion activity. But I would say, where Europe really is different is in the barriers to supply, which are incredibly high, both due to regulatory factors, a lack of land, and constraints on infrastructure. So together, we're looking at Europe being one of our tightest markets around the globe in 2026. Brazil is a little different. It had a kind of late start to the last cycle, and so entered the pandemic boom years from a position where there really wasn't a lot of new development, saw that demand surge. And today it's reaching levels of vacancy that are historic lows. That's really playing through on the rent side. So that's the market we're looking at to have the fastest rent growth. And then finally, on the demand side, India has a extremely positive demographic profile. A lot of international companies are really looking to India for expansion. And so as we think about one of the areas where we'll see probably the most new supply, but coupled with the most demand, that's a market that's really set to boom.
And the outlook talks of a recalibration in US markets. What's causing this and how is it playing out across different geographic markets?
Absolutely. So I would say it's very similar to the way we've structured the international comparison. So within the US, the markets that really boomed, I would say both in terms of demand and rents, were those global gateways. Because of everything that was happening in supply chains in 21, 22, that's where a lot of the growth was. And that's where the correction has been. And that's been playing out in markets like Southern California over the past few years. One inflection factor that I'm really zeroing in on in this particular prediction is that price to value ratio for customers and users of logistics space. And after the reset in rents in markets like Southern California and some other areas, we're starting to see a refocus. I think it combines and overlaps with a little bit more clarity on the trade side as far as tariffs coming into a more narrow range of potential outcomes and companies getting off the sidelines. So really thinking about their global supply chains, how they might future-proof them, build in that flexibility. The rotation then is really about, I would say, shifting from a very inland focus, which has been the last few years. It's really been a lot of demand concentrated in the middle of the country in these sort of regional hubs, and being more balanced in what was normal, frankly, for logistics demand between kind of coastal hubs and inland hubs.
Is e-commerce continuing to drive leasing demand in the US? And is there sufficient capacity to meet that demand?
Absolutely. So first answer, of course, yes. E-commerce has been a factor even throughout the pandemic, but much like we've already talked about, was a boom and then a slowdown, a reset. And we've seen that reacceleration as we expected. Actually, from the early days of the pandemic, we've expected that there's still growth even after everything that happened during the pandemic. And so as we look, not just in the US, but around the world, we see e-commerce continuing to gain share. So to use the US as an example, retail sales growth for e-com in the high single digits versus flat to kind of low single digits for in-store sales. That yields a lot of changes in supply chain. So not only is e-commerce more logistics real estate intensive, so all of your revenue generation activity from a real estate perspective is happening in a warehouse, right? Not that combination of warehouse and store, but it also is very location sensitive. So to do that last mile delivery to meet service level expectations that continue to rise in terms of things like fast delivery times, ease of returns, and the like, you need to get really close to population centers. And so we've seen both, right? As a proportion of new leasing, e-commerce is growing. It's a proportion of retail sales, it's growing. And there's been a refocus on that urban real estate that really enables the last mile delivery.
And we hear so much today about data centers and their massive need for power, but do logistics facilities face their own growing need for power capacity?
Absolutely. And so this is, I would say a theme that's going to affect a lot of different areas of real estate, but everyday life as well. For logistics real estate, first of all, data centers are incredibly power hungry. I don't think we're talking about power loads in the same ballpark at all, but really comparing logistics real estate today to where it used to be. And as we look at the operations happening inside the building, so things like automation, it's autonomous mobile robots, modular technologies that need charging or really built on electricity. That's been adding to power loads for logistics facilities. There is more activity today in sort of the light manufacturing or assembly category, which uses more energy. And then even simple factors like, it's been really hard to find talent to work in logistics facilities. And so we're seeing premium rents being paid and a lot more attention being paid to things like HVAC. Right? Really basic, really simple, but again, adds to that power load. So it's becoming really a top site selection factor as the mix of what's happening inside the building changes. So more automated e-com, for example, or more assembly, but also simply to attract labor, accommodate changing climate, and all the like. It really points in a direction where it's becoming a much more significant factor in site selection.
So this sounds like it's a whole new sort of emphasis for Prologis on these new issues that have to be addressed.
From a corporate perspective, we've been active in the energy game for a long time, one of the top companies in terms of solar on the rooftop. And that's something, again, sort of a long-term trend playing out. And I would say in the past few years, we've seen increased urgency, and it's global, right? Driven by regulation in Europe, driven by cost in certain US markets, and flexibility, right? And this increased need for power, along the border in Mexico. Infrastructure can't keep up with the needs there. And so as you think about positioning yourself as a landlord, the ability to bring on-site power or to really work more closely with utilities and make sure the user has what they need, definitely a big factor as we think about really putting customers at the center of our business going forward.
And an interesting prediction for 2026 in your outlook involves defense-related demand. Can you talk about the geographic impact that could have?
This is an area that I would say comes more from a macro trend and some of the political shifts we've seen recently. So whether it's simply that there's been more geopolitical conflict recently that requires growth in the defense industry, I would say more traditional, whether it's, I would say, the evolution of the technology side and the way businesses run. And so a lot of what we call defense is really cybersecurity. It's really more advanced manufacturing driven, which we've already touched on a little bit. And then politically, the move to increase capabilities in areas like Europe to make up some of the gap that's been highlighted globally. We are seeing significant investment in this area, the One Big Beautiful Bill in the US first, and some of the commitments made in Europe, where demand will ultimately follow. Now, it will take some time. We kind of call out the emergence of this trend in 2026, but over the long term, this is something we think could play out over a number of years. Where it overlaps with logistics real estate, though, is again, one, that power need. So if it is assembly related demand, that really adds, I think, to your site selection criteria. And also where these defense clusters exist tend to be, I would say, your more established, so older, really industrial clusters. So areas like the South Bay in LA or parts of Germany, where the facilities are not your brand new, shiny million square foot buildings, but rather better infrastructure connections, but older, maybe a little bit more smaller footprint space. And I think starting to look at those areas for potential, both of the assembly side, but also the suppliers to that is something we wanted to call out as, again, really an emerging trend during 2026.
The outlook also calls out shrinking capacity in the trucking industry. What's behind that and what are the knock-on effects?
That's a really interesting one because we've been in this freight recession for 3+ years now. It hasn't, I would say, translated as much to the logistics real estate space, which surprises some folks. And I think that really has to do with this, I always say, underappreciated factor where the transportation segments are 100% flow, right? If goods aren't moving from one place to another, you have no growth over there. Whereas in logistics real estate, you've got flow, but you also have storage. So there's this buffer as conditions are shifting. Now, as we look at trucking, the recession there was definitely lackluster demand in some cases. And I would say, especially in 2025, with all of the unique needs of inventory strategy. So front loading really due to tariffs and then drawing down that inventory during the year, we saw a lot more transportation activity shift to intermodal rail. So especially, I would say, out of the ports of LA, Long Beach. As we look forward, two things are going to happen. And one is already happening. Trucking capacity is coming down. And that's a couple of factors. One, 3 years of freight recession, not super profitable companies, especially individual truck operators leaving the business. So that all that lackluster demand and kind of lower freight rates playing through. And then perhaps a resurgence in demand that can come from one of two places. Either sort of aggregate demand. So the economy does better, more goods move. Inventories, I will tell you, are still pretty lean. There's what we call, I've been calling actually just enough. So not just in case, not just in time, but just enough, which is a movement toward more lean inventories. So with inventory costs being high over the past few years, trying to pull those down, and inventories are lean today, but with very selective resilience. So taking your best sellers and making sure you have buffer stock there. So this just-in-time hybrid. As we look forward, if there's continued pressure to have lean inventories, that puts more emphasis on the transportation. It puts more emphasis on the movement of goods versus the storage of goods. And I think that really could shift some of that demand from rail, for example, to trucking. And so as we look forward, the combination of potentially better economic outcomes could improve the demand side, but then even the share shift as inventory management strategies, frankly, return to something a little bit more like the pre-pandemic norm. I think that's really going to help rebalance the trucking side of the freight industry, especially if you take it in concert with that reduced capacity on the supply side.
And what about labor challenges in trucking? Is that also an issue?
Absolutely. So there's been a lot of new regulations and regulatory enforcement. So in the US, for example, an English language speaking requirement that's taken a lot of capacity out of that business. So over the long term, I think that's an industry that has definitely flagged so that it might be harder to find talent going forward. From a location standpoint for logistics real estate, if we think about trucking, I think the key message is very similar to e-commerce, right? The closer you are to populations in terms of storage, the more you're going to be able to minimize that transportation cost factor and any volatility there as well. So whether it's scarcity driven because of labor or demand driven, high competition for the drivers that are on the road, again, we see this as part of that rotation back to putting proximity to cities really at the forefront of your location strategy.
So Melinda, it sounds like lots of factors at play in 2026. Anything else we haven't touched on?
Gosh, we've covered so much. I really think the thing to watch is that in the back half of 2025, we saw an acknowledgement, a real inflection point from customers that said, certainly for a while, we're not going to have perfect information about trade policy, about economic clarity. However, they've moved off the sidelines. I think there's an acknowledgement that supply chains need to be adaptable rather than continue to wait for perfect information. And I think that's really going to shape a return to normal in a lot of different spheres of the logistics real estate market.
Melinda, thanks so much for your time today.
Happy to be here. Thanks, Sarah.
Thank you. And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.